So we've had some new mortgage rules come in the last couple of weeks, and wanted to bring in Tom from our brokerage. He's here at Roll Page Signature downtown office. He's our in-house mortgage broker, and thought it'd be great to ask him some questions about what's going on. Welcome, Tom. How's it going?
Great. Thanks, Mike, for having me.
Yeah, no problem. So let's jump right into this. What are the new changes? They were just announced. When were they announced, and what does it look like?
Yeah, so we had some surprises happening over the last couple of weeks, where the federal government has now announced that anybody that wanted to purchase over $1 million can now get their mortgage insured. So prior to the change, if you wanted to put less than 20% down, there's a maximum purchase price of $999,999. And anybody that wanted to purchase with less than 20%, they would essentially have to come up with 75,000 up to that amount. And now the federal government has announced that we can go up to $1.5 million with less than 20%. So the way the structure works, as it stands now, for the first $500,000 that you borrow, you can put down a minimum of 5%, and then any dollar above 500,000 is at 10%. So if that's if the new scenario is if someone wants to purchase for, say, $1.5 million, then they would need 25,000 for the first 500 and 100,000 for that remaining million. So 1 million plus 500 gives you that $1.5 million purchase price. So $125,000. Whereas before, if you want to purchase for 1.5 million, you needed 300,000. So that's a big difference, especially for first-time buyers, young adults coming out of university, out of school, and they might not necessarily have the means to have saved that much money. Maybe they have the income, but they don't have that down payment, which really kind of held them at that less than $1 million purchase price before. So now with these new changes, it gets them into a different market altogether. As you're probably well familiar with, with what you can buy up to $1 million and the difference between buying from $1 million to 1.5, right? So that's one of the changes. And another change that came out was the amortization period for insured mortgages. So before, the maximum amount of time, the amortization period, so basically if you made the same payment at the same interest rate over a course amount of time, which is the amortization period, you would pay off your mortgage. So prior to these changes, the maximum time was 25 years. And they have now extended that to 30 years. And how that helps is that you're shortening that payment. And as you shorten the payment, the amount of that you can qualify for increases. So I did some math, and let's say, for instance, someone was making $100,000, and they purchased a condo in Toronto. Let's say condo fees were $500 a month. Property taxes, let's say $2,400 a year. That person making $100,000 could afford a mortgage of $400,000. Now, with the amortization period changing to 30 years for first-time buyers, they can now qualify for $425,000, right? So you scale that up. If it's $800,000, now it's $850,000, right? So big changes there. And also it impacts their cost of borrowing. So by extending that amortization period, you can lower the payment. And I calculated for every $100,000 that you borrow, the change from 25 years to 30-year amortization is a difference of $50. So on $1 million
Per month.
per month.
Per month.
So on $1 million, that equates to a difference of $500,000. And on a $500,000 mortgage, that equates to a difference of $250. So, it's definitely something. It definitely will, put some more money in first-time buyers' pockets to to spend on other things, and also the qualifying for higher amounts.
Okay, so that's a lot of changes that have been announced. Now,
Right.
just to kind of rewind a little bit, so you mentioned the down payment now is changing when you go from a million up to 1.5. So if someone is, let's say, maybe in the past they were limited by the 999, 999 price point because they didn't have the down payment. Now, with those buyers, if they had almost essentially half the down payment that you used to have, could now enter into the above the $1 million mark.
Correct.
Do you feel that that's going to impact things from a borrowing standpoint? Like, will those buyers be able to qualify to borrow more if they do have the down payment?
Absolutely. I know that with clients that we work with, they're at the mercy of their down payment, right? Say they might have $100,000 saved, uh, but they, they make good money. They make, six-figure salaries, combined incomes, even, with partners coming together, and they can afford a $1.2 million home. But as soon as you cross that $1 million threshold, they were automatically required to put down 20%. And like I said, they were at the mercy of their down payment. Now, if you have that $100,000 saved, you can definitely get into that different stage of home. Maybe going from a condo to now a townhouse, or maybe a bungalow. So that definitely helps for sure.
And those rule changes are proposed to be implemented on December 15th this
Correct.
year.
Correct.
Now, would it make a difference if someone purchased today and closed after December 15th, or is it really only from someone who's purchased after December 15th?
Yeah, I wouldn't necessarily recommend it, just because with the new announcement, there hasn't been a lot of literature that's come out in terms of what the CMHC premiums will be, and even as of today, because the new rule hasn't taken into effect, we couldn't put an application in with a closing date after December 15th. The lender would just decline it because the policy hasn't been into effect. So we do get asked that question a lot. Well, what happens if I close in January? What happens if I close in February? Again, because the literature hasn't come out yet, and everything hasn't been written out in terms of what the underwriting practices will be for this new change. I wouldn't necessarily recommend anybody that has less than 20% to purchase before the new rule comes into effect, and to qualify after December 15th would probably be a wise choice for sure, as opposed to prior to.
Great. And now, when we talk about CMHC, can you unpack a little bit what that is, and how does it affect? So, if you are putting down less than 20%, so less than 20% is an insured mortgage,
Right.
regardless, right? So, if you are putting down less than 20%, what does that look like from your mortgage balance standpoint? What's the insurance premium, and how does it get factored into the equation?
Yeah. So again, whenever you're putting less than 20% down, the mortgage is considered insured. It's considered a high risk mortgage and requires default insurance. So there are insurers out there, CMHC, Canadian Mortgage Housing Corporation, Sagen, and Canada Guarantee. Those are the three that we use here. And essentially what they'll allow Canadians to do is, if you don't have that 20% to put down, you can put less than, and they will insure you. So your mortgage will be insured, meaning that if you default on your mortgage, it doesn't, the insurer will come in and take over that loan. It's not at the risk of the lender. And the way it works is there's an insurance premium that gets added to your mortgage. So there's different tiers. So if you put, say, 5% to 9.99%, 10% to 14.99%, and 15% up to 19.99%. But the lowest tier, the 5 to 9.99%, there's an insurance premium of 4%. of the mortgage amount. So if you were to put, let's say you purchased a property for, 500,000, and you put down 25,000, your mortgage would then be 475,000. They would charge you a 4% premium on that 475, which works out to something like $19,000, or let's call it $20,000, right? And that $20,000 now gets added to that mortgage amount. So if you purchased for 500, you put down 25, then that insurance premium gets added to your mortgage. So essentially now your mortgage is at 495, right? So it's a one-time premium. Even I get this question asked a lot. Well, what happens if the equity in my home increases and I have more than 20% equity? Do I get that insurance premium back? And the answer is no. Once you pay it, the mortgage is insured. And if in the future you decide to sell that property and move up to another property where you've built enough equity for that 20%, then at your next purchase you're not required to get that default insurance, nor are you required to pay that premium anymore once you get past that 20% threshold.
So it's a one-time fee payable on closing, and then it's added to your mortgage balance. Then you don't have to pay it again at any point in time. It's
Correct.
just added right away.
And consumers do have the option of paying it upfront as opposed to having it put onto their mortgage. But usually what we find is that if they had that money, that extra money, then they would have just increased their down payment, right? So 99.9% of the time for insured mortgages, people just add that insurance premium to their mortgage. And when you do meet with your lawyer to sign the mortgage instructions, they are required to pay the PST on that insurance premium. So if you're paying $20,000, then you are required to pay tax on top of that as part of your closing costs.
PST is provincial sales tax. So in Ontario, it'd be 8%.
Correct.
Of the
insurance premium.
Of the insurance
So if
premium.
your insurance premium was, say, $20,000, then 8% would be, what's that, $1,600.
Give or take.
Yeah.
Or exactly.
Yeah, $1,600, which gets paid as part of your closing costs.
Okay. Great to know. There's been two other changes that have come in. The first one has to do with new construction properties. What is the change there for the new construction properties?
For sure. So with new construction properties, anybody that's purchasing new construction and they're getting an insured mortgage, again, prior to the rules, the maximum amortization period was 25 years. And so you don't have to be a first-time buyer to purchase new construction and put down less than 20% to have a 30-year amortization. So people are always like, well, can I get insured mortgage if I've owned a property in the past? And the answer is yes. As long as you are purchasing this property as your principal residence, then you can get an insured mortgage for this new construction.
And it has to be your principal residence.
Has to be a principal residence.
Okay. So if you purchase a property today, it's going to be delivered in 4 years, let's say. The intent would be to move in there in 4 years, and then you can qualify for the 30-year
Correct.
amortization.
Correct. And it can, it just can't be like a rental property, like a one-bedroom suite rental properties. Now, you can get insured mortgages for multi-unit, but again, that's just a completely different topic.
Okay. Let's not jump into that for today. The other piece, just before jumping into the new stress test rule that just came out, that new mortgage insurance rule where you don't have to get the 20% down up to 1.5 million, that's not only for first-time buyers, is it?
No. Again, if you're purchasing for a principal residence, family dwelling, then you don't have to put down the 20% if you're a second, third-time buyer, and it's not just limited to first-time buyers.
So someone, for example, purchased a condo a few years ago. They've maybe seen, $100,000 in equity growth in that time, as an example. Maybe it's not quite enough to have gotten them to the 20%, but it's enough to get them to that minimum down payment that they need for the next, let's say, a detached property or
Correct.
a bungalow or something. So they could still also take advantage of that new rule coming into play as of December 15th.
Yeah, exactly.
Great.
Yeah.
And the next piece, mortgage stress test rule. So with all the talk about renewals coming up, how does this new stress test rule factor into the mix here?
Yeah, so prior to this rule, if you had an insured mortgage and you were to transfer it from, say, from one lender to another lender, you still have to requalify when you're switching your mortgage. Even though your balance is remaining the same, your amortization period is staying the same. But if you're changing from, let's say, Scotiabank to TD Bank, in the past, you would have to requalify. And so if you're getting an interest rate of, let's say, 4.5%, when you have to qualify, you qualify at what we call a stress test. So you have to qualify at the rate that you're getting plus 2%. And again, that's just to make sure that if in the future interest rates are higher, that homeowner can can afford those payments if when the renewal comes up that interest rates are higher. So that's why they have that variance of 2% just to make sure. So with these new rules that's coming out for mortgages that are if you have more than 20% equity in your property, you would have to qualify at your contract rate plus 2%. Now they've come out saying that if you want to transfer from one lender to another lender and your interest rate is 4.5%, you can actually qualify at that 4.5%. And why that's a win for consumers is in the past, because especially with interest rates as high as they are today, where as of 5 years ago, they were at say 2.5%, and somebody may have qualified just under that mark. So at today's interest rates, they might have not qualified to transfer that mortgage at a qualifying rate of, let's call it 6.5%, right? And they were stuck with that bank or that institution that they were with, and whatever rate that they wanted to, whatever rate that the lender was offering them, they were stuck because they couldn't qualify. So it's a big win for consumers now that they can qualify at the actual contract rate, and this gives them more options to shop around to get better interest rates and essentially to save money, save themselves money.
So effectively on renewal date, so let's say you've been in your mortgage now coming up on 5 years and you're at the mortgage renewal rate, instead of having to kind of take what your bank or your lender is offering you, now you have the ability to shop that around.
Correct, yeah.
And see if there's a better rate out there, and you don't have to go through the full stress test of trying to qualify at, for example, 6.5%. And is it a difficult process to do that? Is this something that...
To transfer a mortgage isn't really difficult. You still have to requalify. But again, now you're qualifying at a much lower rate. And, for some that were wanting to switch mortgages or mortgage lenders, and they were switching at their actual rate plus 2%, and they didn't qualify, then again, they'd be stuck at renewing with that lender and whatever that lender's was offering in terms of interest rates. And again, now that they're qualifying at a lower rate, opens up options to go elsewhere and to get lower interest rates if that's what's being offered to them.
Yeah, and even if your bank is offering you something and another lender is offering you something else, it gives you the ability to negotiate a little bit too on renewal.
Yeah, exactly. And some people, over the course of their mortgage, whether it be a 5-year term, they might not necessarily be, that secure being with that lender. Maybe they had bad experience, maybe they had bad customer service. We hear it all the time that, I'll never deal with this bank ever again, right? So in this situation now, if they have a bad taste in their mouth with that particular lender, they're not again forced to have to renew with them. That now they have that option to shop around and maybe go to a lender that they're more happy with.
That's great. That's a great move for consumers. Obviously,
Absolutely.
Definitely a positive.
A lot of great moves in the last couple of weeks that have come out. A lot of good announcements that will definitely help out consumers for sure.
Amazing. Well, Tom, that's it for today. Thank you so much for jumping in. There's I've had so many questions on this stuff, so happy to hear it from a professional like yourself that can break everything down. How can everyone get a hold of you if they did want to discuss whether it's a renewal, whether it's a new mortgage, or the new rules?
Yeah, for sure. Well, like my name is Tom Miocevich. I'm with Dominion Lending Centers, and the easiest way to get a hold of me is by phone, and I've got an easy phone number to remember. It's 416 low rate.
Wow. Okay. When did you lock that one in?
Probably 20 years ago when I started this. When I started in the mortgage industry.
Awesome. Okay. Thanks, Tom. Appreciate you coming on.
Yeah, thanks for having me, Mike.
Thanks.